गुड मॉर्निंग हर्षी।
गुड मॉर्निंग सर।
बाकियों को भी फॉलो करते हैं, अभी तक ज्वाइन नहीं किया किसी ने। अश्विन जी ने एटलीस्ट पूछा था।
सर ये लास्ट वीकेंड का जो गोपाल जी और कविता जी का सेशन था, उसका पीपीटीज नहीं है वो शेयर ड्राइव में।
कोई दिक्कत नहीं है, वो आज उसको दोबारा फॉलो अप करके, आज गोपाल जी की क्लास है।
ओके।
हाँ।
और सर मैं वो एनआईएसएम की वेबसाइट पे मैंने प्रोफाइल बना दिया है लास्ट वीक ही। तो मैंने 3-4 दिन जाके देखा सीट अवेलेबिलिटी का,
लेकिन
तो
वो नहीं मिली।
नहीं, वो दिसंबर तक नहीं मिल रहा था। मतलब
नहीं
मैंने
एक्चुअली नहीं, इसके लिए मैं बताता हूँ। एक्चुअली क्या है, वो सीट खुलते ही 15-20 दिन या महीने भर के लिए, इसलिए हम दिसंबर या अगले दिसंबर भी चेक करेंगे ना, तो वो यूजलेस है।
अच्छा।
हाँ, और सोशल डिस्टेंसिंग के चलते जो सीट आपको आज नजर नहीं आ रही, हो सकता है कि कल नजर आ जाए।
अच्छा, और मतलब ऐसा है कि हमें ट्रेनिंग का जो कंप्लीशन सर्टिफिकेट है वो अपलोड करने के बाद ही सीट दिखेंगे?
ना ना, ऐसा नहीं, बिल्कुल भी नहीं है। आप कोई भी डमी नंबर डाल दिया आपने, लेट से आप वही कर रहे होगे।
राइट राइट।
मैं भी यही करता था, नो डाउट, इसलिए मुझे पता है।
ओके
प्लस आपको मेंबरशिप नंबर डालना है। सर्टिफिकेट अपलोडिंग इज नॉट मैंडेटरी।
ओके ओके
हाँ।
ओके।
सो जो आपको सर्टिफिकेट मिलेगा उसके अंदर मेंबरशिप नंबर डाल के आप आगे प्रोसीड कर सकते हैं।
ओके ओके।
सुनील, एक बारी गोपाल जी को फोन कर लीजिए। और मैंने रिकॉर्डिंग पोस्ट करी है, जब तक स्टार्ट नहीं हो जाए ना, इसलिए रिकॉर्डिंग मैंने ही पोस्ट करी हुई है।
ओके सर, आई विल कॉल हिम।
हाँ। राजू जी का आ गया, राजू जी को कॉल करने की जरूरत नहीं है, राजू जी का मैसेज आ गया, ही इज ज्वाइनिंग इन 2 मिनट्स। सुरेंद्र जी, प्लीज ऑन योर ऑडियो एंड वीडियो। ये सुभी जी कौन है हमारे यहाँ? नमस्कार सर। सर आपकी डिवाइस का नाम कुछ हो रहा है, इसलिए मैं कंफ्यूज हो गया कि सुभी जी कौन है। सर अपने आप को अनम्यूट करो और अपना नेम को रीनेम कर लो।
जी जी जी।
हाँ, क्योंकि एक्चुअली क्या होगा, आपने डिवाइस अपने फैमिली मेंबर के लिए होगी।
हाँ, वो बेटी के नाम, बेटी का देखना है।
वो मेरे बच्चे मेरी क्लास कर रहे होते ना, तो उनकी टीचर ने कहा विजय कुमार गुप्ता कौन है।
और सर?
बस सर, सर जैसे क्लास खत्म हो,
जी
कल आपको सर्टिफिकेट मिल जाएगा
जी।
स्लॉट ढूंढ के इमीडिएटली बुक करा देना। हर
ठीक है
फैकल्टीज
सर।
का कहना अलग है। कुछ
ठीक है
कहते
सर।
हैं जी तैयारी करो, मैं ये नहीं कह रहा हूँ तैयारी मत करो। जितना जल्दी दे दोगे ना उतना जल्दी पास हो जाएगा, क्योंकि आपकी हमारी जो उम्र हो चुकी है ना,
जी जी जी
ये
जी।
लंबा पढ़ने की उम्र नहीं है, वो है ना।
सही कह रहे हो। नहीं, वो तो फैकल्टी भी कह रहे थे, ये बोले जी अभी तो आपके दिमाग में चल रहा है चीजें,
यस।
और 1 महीने बाद पता लगे आधी चीज रह गई।
मैंने बिल्कुल नेक्स्ट वीक, इस संडे खत्म हुआ 29 दिसंबर को, और 5 जनवरी को मैंने एग्जाम पास कर लिया था।
वेरी गुड सर, वेरी गुड।
और पढ़ के ऐसा नहीं कि कोई मैंने कोई 30 मार लिए थे, जो
नहीं, ठीक
दिमाग में
बात
था
है।
ना,
नहीं,
62
ठीक बात
नंबर
है।
आए, 23 क्वेश्चन मेरे भी गलत थे। ठीक है ना,
जी जी
लेकिन पास हो गए।
जी। हाँ सर, मेन तो पास पास का में चाहिए भी, वो तो स्कोरिंग कौन ज्यादा चेक करता है,
यस, पास ही।
क्वालिफिकेशन ज्यादा चाहिए बस।
सर जैसे सीए में भी हमने कभी
बिल्कुल
रैंक
बिल्कुल,
लाने की थोड़ा ना सोची थी।
सही बात है। सही बात है सर। नहीं देखो, फैकल्टी सारी आपकी मतलब है ना, बहुत ही सिलेक्टेड है, मतलब आई अप्रिशिएट।
सर ये अपने गोपाल जी तो एक्चुअली एसआईआरसी के 3 टाइम सिलेक्टेड मेंबर रह चुके हैं।
ओके।
एंड ही इज ए मल्टी टैलेंटेड, मतलब हर सब्जेक्ट के
नहीं,
अंदर अच्छा बोल रहे हैं।
ठीक
सारी
बात
सी
है
की
सर।
ब्रांचेस में बोल रहे हैं, सीए, सीएस, सीएमए, पीएचडी, चैम्बर ऑफ कॉमर्स, इन सब जगह बोल रहे हैं, और एज ए प्रोग्राम डायरेक्टर रहते हैं।
मेन क्या होता है, जो स्पीकर होता है ना, वो कितना अट्रैक्ट कर पाता है व्यूअर्स को, वो चीज है मेन तो।
हाँ, तो उस मामले में ना इनकी, और थोड़े से टाइट भी रहते हैं जी, इसको सेमिनार
हाँ
की तरह
टाइट
अटेंड ना करें,
होना जरूरी है सर, जरूरी है, नहीं तो
बहुत
फिर।
जरूरी है।
हाँ, क्योंकि तो वैसे भी मतलब डिस्टेंस लर्निंग में तो बहुत ही दिक्कत होती है चीजें,
यस यस।
क्योंकि जो हमारा एनवायरनमेंट है ये तो बिल्कुल कैजुअल एनवायरनमेंट होता है,
सर
घर में
1
बैठे
महीने
रहो।
पहले भी हमने जूम को अडोप्ट नहीं किया था, मतलब मेरे पास 2-3 साल पहले भी मीटिंग्स हुई, लेकिन कभी जूम नहीं किया।
हम्म।
और जोहो के और जूम के बीच में काफी टाइम से फॉलो कर रहा था, लेकिन अब मजबूरी में करना पड़ा।
ठीक बात।
नमस्कार सर। नमस्कार
सर। नमस्कार जी।
सर, यू आर इन ऑफिस और घर पे ये ऑफिस बना रखा है एडिशनल?
What sir?
सर करंटली यू आर इन ऑफिस और
Office.
रूम इज ऑफिस? ऑफिस कल्चर में सर ऑफिस आ जाता है माहौल।
Because in home,
यस यस।
the Wi-Fi that may not be.
सर मेरे पीछे भी कभी मेरे बच्चे जा रहे हैं तो वो हो ही वो तो होगा ही होगा, लेकिन देयर इज ए डिस्टेंस ऑफ 25 किलोमीटर्स फ्रॉम माय होम एंड ऑफिस। दिल्ली में तो सबके साथ मोटा मोटी ऐसा मिलेगा। वन टू थ्री फोर फाइव पार्टिसिपेंट्स जुड़ चुके हैं। सर आज लंच ब्रेक के बाद में एक एमसीक्यूज का टेस्ट होगा एज पर आईबीबीआई गाइडलाइंस। सर का सेशन 2 बजे खत्म हो जाएगा, 2 से 3 का लंच रहेगा, 3 से 4 का एमसीक्यू बेस्ड टेस्ट रहेगा 50 क्वेश्चंस का, फॉर योर लर्निंग पर्पज ओनली एज पर आईबीबीआई गाइडलाइंस। उसका फाइनल एग्जाम से कोई कंसर्न नहीं है।
वो चेक करने में कितना तुम्हें याद है अब तक?
यस
I will join in 5 minutes. Sir.
यस सर।
I'll be online.
यस सर यस सर। और एक 2 पार्टिसिपेंट्स हमारे पास हो चुके हैं, मनीष अग्रवाल जी और चेतन अग्रवाल।
नहीं सर, कांग्रेट सर, वो मिल गई थी हमें खबर।
तो 4 से 5 एक उनका सेशन भी करवाऊंगा कि क्या एग्जाम में क्या आ रहा है।
ठीक बात है, जरूरी है सर, जरूरी है।
हाँ, उस सेशन में मेरे सारे बैच के मेंबर्स रहेंगे जिनकी अवेलेबिलिटी होगी।
जी जी।
हाँ, तो अपने जैसे कि तकरीबन 46 मेंबर्स हैं जो टोटल हो चुके हैं अब तक। तो वो सब अटेंड कर लेंगे भाई एग्जाम में क्या क्या पैटर्न आ रहा है, तो वो करंट सिनेरियो बता देंगे।
ठीक बात है
सर। अभी मैं देख रहा हूँ एनआईएसएम पे 22, 23, 24 सितंबर का दिख रहा है।
दिख रहा है ना? कल नहीं दिख रहा था?
नहीं, कल नहीं दिख रहा था।
हाँ, तो सर इसको इमीडिएटली बुक करा दीजिए। मैं आज शाम तक आप अगर शाम तक मेरे पास मेंबरशिप नंबर होगा तो मेंबरशिप नंबर में दे दूंगा, सर्टिफिकेट आपको कल मेल पे आ जाएगा।
ओके।
एंड देयर इज नो नीड टू अपलोड सर्टिफिकेट, वो मैंडेटरी नहीं है। तो उसके लिए मेहनत ना करें कि सर्टिफिकेट को स्कैन करें, फोटो खींचें, सिंपली मेंबरशिप नंबर लिखें। मैंने यही करा था। हाँ,
अभी मैं बुक नहीं कर सकता ना विदाउट
मेंबरशिप नंबर की बिना नहीं कर सकते।
मेंबरशिप नंबर, राइट।
मैं आज पूछ लूंगा, अगर विद इन द सेशन भी मुझे पता लगा तो आई विल शेयर ऑन द ग्रुप इटसेल्फ।
श्योर, थैंक यू।
जो सीरीज होगी वो AIIOVF/SFA/10,000 में वो नंबर आपका क्या आना है।
ओके।
हाँ, जो भी नंबर आना है 47 से 58 के बीच वाला नंबर है।
ओके।
सुनील, आप एक 4 से 5 बजे का एक लिंक बना देना मीटिंग का।
ओके सर।
एडिशनल लिंक बना देना कि 4 से 5 बजे एक ओवरव्यू। मैं एक मिनट चेक करता हूँ उन्होंने क्या नाम दिया था। उसमें हमारे सारे बैचेस के रहेंगे। एक्सपीरियंस सेशन बाय द पास आउट स्टूडेंट्स, पास आउट मेंबर्स। तो कुछ भी है ना, मुनीष अग्रवाल जी ले रहे हैं, उन्होंने एक पीपीटी भी बना ली है। क्योंकि वो क्लास हमारी अनऑफिशियल ही रहेगी एक तरह से। उसको एक्सपीरियंस सेशन लिख देना सुनील, एक्सपीरियंस सेशन। और वो बाकी ग्रुपों में शेयर भी कर देना। अभी तक 6 जुड़े हैं सुनील, एक बार सबको इंडिविजुअली भी व्हाट्सएप कर दो। बीच में अमित अग्रवाल जी भी जुड़े थे, चलो इस बार तो जुड़ ही जाएंगे। रोहित जी सबसे पंक्चुअल थे, सबसे सीनियर मोस्ट हैं, आज वो भी नहीं जुड़े। कोई बात नहीं, जा बेटा जा।
Sir, I have messaged to everyone who have not joined yet individually.
ठीक है गोपाल जी, only 6 participants have joined, बाकी 3 participants have said they will joining within 2 minutes, 3 minutes.
Yes, sir.
सुनील, आफ्टर दिस सेशन अगर
sir.
हमारे पास मेंबरशिप नंबर हो तो सबको शेयर कर देना मेंबरशिप नंबर।
Okay, sir. I'll share.
ठीक है ना, ताकि अपने बैचेस को ये स्लॉट बुक कर सके।
Okay, sir. I'll share.
एक्चुअली जितना सेशन टुडेज का, आज का सेशन जितना मजेदार है, बाकी सेशन से ज्यादा इंटरेक्टिव रहेगा। टुडेज सेशन इज ओनली ऑन केस स्टडी बेसिस एंड मच स्कोरिंग
सर फेयरवेल सेशन नहीं,
क्योंकि केस स्टडी में मेरे 20 में से 20 आए थे, बाकी 23 क्वेश्चंस वर रॉन्ग इन माय पासिंग अटेम्प्ट। निखर जी, प्लीज ट्राई टू यूज लैपटॉप और डेस्कटॉप। गुड मॉर्निंग प्रीति जी।
सर एक्चुअली मेरे लैपटॉप में क्या है, वो कैमरा वो वॉइस नहीं चल पा रहा है, बाकी तो
एग्रीड मैं समझ गया, मैं भी ऐसे ही इस्तेमाल करता हूँ। आई यूज 2 डिवाइसेस इन द ऑफिस, वन इज डेस्कटॉप एंड फॉर ऑडियो पर्पस आई यूज मोबाइल।
ओके सर, आई विल।
So additionally if you have laptop and using without audio and video, then it is okay.
ओके सर।
Shall I proceed?
Yes sir, yes sir.
Thank you very much, sir. Very good morning, folks. At the outset, let me thank AIIOVF and its team, especially led by the Managing Director, CEO Vijay Kumar Gupta. Today, we are going to have a very interesting and most relevant and mark scoring topic. So, which will be on case studies with respect to fixed income securities. So, I'll try to go step by step, which is very important and interesting. Questions will be both from a 1 mark question perspective as well as a case study perspective, because we all know that there will be 20 marks which will be focused on case studies, where there will be 3 questions, and possibly there will be maximum 4 or 5 1 mark arithmetic also possible. So you can expect maximum up to 25 marks in arithmetic part. So we'll try to actually appreciate in all the angles. So step by step, we'll try to understand this thing. Now, this is your syllabus, which we have already went through. And I'll try to refer to some of the areas, and then I'll try to take some questions. Please look at this. There is a term called forward rate and spot rate. So this is one point which we'll try to understand today. And this comes under the terms used in fixed income securities. Probably you may get maybe concept questions or even arithmetic questions on this particular topic. So let me first take you to that part. So I'll explain this concept first, and I'll try to solve 3 types of questions. One, where spot rates will be given, you have to find the forward rates. Another, forward rates are given, you have to find the spot rate. Another very different question, where you have to find the spot value, which is the spot price. So if forward rates are given, as well as spot rate. May I request Lokesh Mittal to kindly mute your audio, please? And yeah. Now, first point, what I want to share with all of you is, what is the relevance of a spot rate and a forward rate? And here we will be discussing about the interest rate, the spot interest rate and forward interest rate. I'll first explain to you in a simple manner. Now I'm giving you a small example. So with this, we'll try to appreciate, so that we'll understand the relationship between a spot and a forward rate. All of us, we know one thing very clear. Spot rate means today. Forward rate means tomorrow's rate, day after tomorrow's rate, 3 months later, 1 year later, 2 years later. So that's called a forward. So it's not going to happen today, it's going to happen later. Now let me take an example. The example is, you have a money with you. You have a money with you. You want to invest in a, you want to invest and you want to earn interest. Now, you have, say that is a 2-year period you want to earn interest. Method 1, I'll just give you two methods. Number 1 method, you want to invest today. The interest rate is fixed today, which will be paid to you periodically. You want it yearly once or quarterly once or half-yearly once, whatever it is. That is a different one. How you are going to get the interest is a different one. Accumulation of interest will happen yearly, let us take. And you are going to withdraw at the end of 2nd year. Now, the rate is offered today. Please come invest now. I'm going to offer an interest rate. And that interest rate is 6.5%. S2 spot 6.5%. So you invest today, for the next 2 years, you will be paid 6.5% rate of interest. Good. Happy. Option 2. Another bank is offering, we'll offer you 6% for the first year. Okay. You withdraw and you reinvest in another scheme. End of the first year. End of the first year, reinvest in another scheme, for which we'll give a rate of interest at 7%. That is also committed today. Which is committed today. 1 year later, if you invest in this particular scheme, we'll pay you 7% from first year end to second year. This is called forward rate. So I'm going to pay for the end of the first year to end of the second year, okay, an interest which I'm committing today. That is called forward rate. And that is called, maybe I'll call it as F1. F1 is the rate that starts with the end of the first year. This is called forward. So first year you'll invest at 6%. Second year you'll invest at 7%. So this is called spot and forward. Now, if these kinds of things exist in the market, what will happen? One type of market will try to pull the customers to one side. Now, for example, first year spot rate and forward rate. Forward rate is say 7% higher. For example, forward rate I pay 8%. First year is 6% and second year 8%. Then naturally people will go for that. Now, to bring buoyancy, okay, to bring equilibrium, I'm repeating the word, okay, very important word. To bring equilibrium, the spot rate for the 2 years will be corrected, there will be a correction in the spot rate for 2 years, which will increase or decrease, which will actually adjust itself, correct itself to its the overall return for the first year at spot rate and second year at forward rate. What is the overall return? That will be equivalent to the spot rate for 2 years. This is the relationship which is represented like this. So 1 plus 2 year spot rate cumulative. Okay, we already know this. Okay, present value into 1 plus r whole power n. You know this. I'm just removing that present value as you take 1 rupee, you take 100 rupees. So you have here you have to put the present value. Present value into 1 plus r whole power n and 2. That is 2 years. And n is your 2-year interest rate. So that is S2, 2-year interest rate, which will be equal to your present value into 1 plus r for the first year whole power 1 into 1 plus r whole power 1. So that will be the forward rate. So this is the logic, and I will extend this formula. I can extend it for the second year also. What is second year? 1 plus S3 whole cube is equal to 1 plus S1 into 1 plus F1 into 1 plus F2. Similarly, 1 plus S4 whole power 4 is equal to 1 plus S1 into 1 plus F1 into 1 plus F2 into 1 plus F3. This is what the relationship is all about. So let us now do one question. How to find the forward rate? How to find the forward rate if spot rates are given? Okay, so let's do that question. So I'm doing question number 1. Okay, now here you have here 1, 2, 3, 4, 5. 5. You have the spot rate, which is 3.5%, 4.6%. 5.4%, 6.1%, 6.3. So this is your spot rate. Now, what is your forward rate? Your forward rate is not known. We have to find it. Okay. So this is what you have to find. So let us work it out one by one. And all of us, we knew this. This is actually your F1 you have to find. This is F2. This is F3. This is F4. Okay. Let us find out this. So we knew the formula. What is the formula? It is 1 plus S2. Okay. The whole square is equal to 1 plus S1 into 1 plus F1. So this is with respect to your first year. So I'll only connect this. So 3.5%, 4.6%, and F1. So now what is 1 plus F1? 1 plus F1 is 1 plus S2 whole square divided by 1 plus S1. And what is F1? 1 plus S2 whole square divided by 1 plus S1 minus 1. That's all. So that is F1. So we all know this. So find F1. Okay. So how do I find? So here I will say S2 is equal to 3.5%. S1 is equal to, S2 is equal to 4.6%. S1 is equal to 3.5%. Okay. And what is F1? Which has to be found. So this is what is given. Okay. Now let me substitute it here and I'll find out. Now, as I already told you, 1 plus F1 is equal to 1 plus S2 whole square divided by 1 plus S1, because 1 plus S1 will go to the other side. And F1 is equal to 1 plus S2 whole square divided by 1 plus S1 minus 1. So directly I will calculate F1, which is equal to 1 plus S2, the whole square. Okay. Divided by, okay, 1 plus S1. Okay. So the whole minus 1. So this is your 5.71%. 5 point. And generally it will be average of, it will be an equilibrium of between your S1 and S2 always. That's what the example also I just now showed you. The example, S1 is 6, forward rate is this, spot 1 is, S2 is actually, S1 is 6, and S2 is in between these two. So it will be like that. Okay. So F1 is actually 5.71%. So this is with respect to F1. Let us try, so please look at this one. S2 is what, this is actually average. S2 is actually average of 1 and F1. 1 is what? 3.5. What is F1? 5.7. So S2 will be in between S1 and F1. So that's what it is. Now let us try for the next one. So find F2. So how will you find F2? It is 1 plus S3 whole power 3 is equal to 1 plus S1 into 1 plus F1 into 1 plus F2. Okay, so meaning Either you invest 5.4% for 3 years, or you invest for the first year 3.5%, second year you invest 5.71%, and third year you invest another forward rate that you have to find out. Put together, whatever the total return you get will be equivalent to 5.4% for 3 years. Okay, so that is the meaning of this. So how to find F2? Directly we'll find that. So what is S3 here? 5.4%. What is S2 here? Sorry, S2 is not required. What is S1 here? 3.5%. What is F1 here? 5.7%. So therefore, without calculating F1, you can't calculate F2 in this particular question. Now, how do we find F2, which is 1 plus S3 whole cube divided by 1 plus S1 into 1 plus F1 whole minus 1. That will be F2. I hope you are able to understand what I am saying. So 1 plus S3 whole cube. This will be in the numerator. Okay. Divided by 1 plus S1 into 1 plus F1, or maybe I'll put it here. Okay. The whole bracket minus 1. You have to be very careful while doing this. So it is 7.02%. So this is your answer. 5.71%, 7.02%. F2. So hope you can try similarly F3 and F4, which is you have to be very careful. Okay. So let me try F3 now. So how to find F3? So 1 plus S4 whole power 4, which is equal to 1 plus S1 into 1 plus F1 into 1 plus F2 into 1 plus F3. Okay. So you have now got F1 and F2. You have to find F3. So what is F3? So what is S4 for you? S4 for you is 6.10. So what is S1? S1 is 3.5%. What is F1? F1 is 5.7%. What is F2? We have already computed. It is 7.0. What is F3? We have to calculate. Okay. So F2 here is a question mark. F3 here is a question mark. So now let's find F3. So F3 is equal to 1 plus S4 whole power 4. Mr. Jacob Oman and Subbu, kindly mute yourself. So F3 will be 1 plus S4 whole power 4 divided by 1 plus S1, again divided by 1 plus F1, divided by 1 plus F2, and whole minus 1. So that will be F3. So let's do that. So which is, you have to be very careful with the bracket. So 1 plus S4 is 6.10 whole power 4, close the bracket, divided by 1 plus S1, okay, into 1 plus F1 into 1 plus F2. Okay. So this will be your numerator, denominator. The whole you have to subtract by 1. So which is 8.22%. Yeah, or 8.23. Good. So this is your F3 answer. So you have to be very careful. So hope you are able to follow me. Okay. Now let us find F4 similarly. Okay. So the formula will still become bigger. So how to find F4? So 1 plus S5, okay, 1 plus S5 whole power 5, okay, whole power 5, which is equal to 1 plus S1 into 1 plus F1 into 1 plus F2 into 1 plus F3. Okay. Now you need to go for 5 more. Okay, 5 terms should be there. So if it is to the power 4 means 4 terms, to the power 5 means 5 terms. So it is only up to 3. So into 1 plus F4. So how do I find now F4? So F4 is equal to 1 plus S5 whole power 5 divided by 1 plus S1 into 1 plus F1 into 1 plus F2 into 1 plus F3, the whole bracket minus 1. So this is equal to 1 plus S5. I will take this as S5. Okay, 6.3. Maybe I'll put it here. So all of you will know. So S5 is 6.3. And S1 is this. F1 is 5.7. F2 is actually 7.2. F3 is actually 8.23. Okay. And we need to find what is F4. So F4 is question mark. Okay. So what is F4 now? It is 1 plus S5 whole power 5 bracket divided by 1 plus S1 into 1 plus F1 into 1 plus F2 into 1 plus F3, the whole close the bracket. This is will be your denominator. The whole close the bracket minus 1. So this is your forward rate for the, the 5th year, which is F4. From 4th year to 5th year, I'll be paying 7.1%. So this is how the forward rates are calculated. So how to find the forward rates if spot rates are given? Now I'll just give a reverse question. How will you find the spot rate if forward rates are given? And here I'm not asking all the questions. I'm only asking only one. Please look at this. The 1 year spot rate is 4%. That is S1. The forward rate for year 2, 3, 4, 5. That is F1, F2, F3, F4 is 5%, 7%, 8%, and 6%. Then what is today's interest rate on a 5-year bond should be? That means a spot rate for 5 years. What is the meaning of spot rate? Today's interest rate, spot interest rate for a 5-year bond. So that means spot interest rate for 5 years. So please be clear about these English, how they are connected with the spot and forward. Okay. The purpose of these kind of questions is only to make you understand how those forward rates and spot rates are interconnected. Okay, good. So you have multiple answers here. We have to find the right answer. So I'll only use this last formula. Okay, this is the formula I have to use. Huh? So I'll go to question number 2. So we are here. So if 1 year spot rate is 4%. So I'll just note down this here. So here 1, 2, 3, 4, 5. So we have the spot rates. You have the forward rates. So the spot rate is 4%. Now the forward rates are given 5, 7, 8, 6. So what you have got, S1 you have got. S1 is 4%. F1 you have got 5%. F2 you have got. So this is F1, this is F2, this is F3, this is F4. Okay. So what is F2? 7%. So what is F3? 8%. So what is F4? 6%. So now they are asking spot. So what they are asking? They are asking S5. So what is S5? Okay. So how to find S5? So we have the formula here. So I don't need to type it again. So this is your formula. Now you have all the right hand side. Only left hand side is not there. So what I will do? 1 plus S5 whole power 5. What is n plus S5 whole power 5? Which is equal to 1 plus S1, which is 4%, into 1 plus F1, which is 5%, into 1 plus F2, which is 7%, into 1 plus F3, which is 8%, into 1 plus F4, which is 6%. So now what you have got? You have got the left hand side you have to find. Now you have got the right hand side. So your right hand side is actually 133. Maybe I'll keep it in comma. 1.3376. So now what I will do? 1 plus S5 will be equal to fifth root of 1.3376, because this is to the power 5. So I will take fifth root both sides. If I take fifth root both sides, 1 plus S5 whole power 5, fifth root will become 1 plus S5. And I have to find the fifth root of 1.3376. So which is 1 divided by 5. Or 0.2, you can put it 0.2. So this is your 1 plus S5. So S5 is equal to 1.06 minus 1, which is 0.06. Otherwise in percentage, it is 6% or 5.9%. So this is your, S5. So what is your answer? 6%. So C. In the previous question, the choice is not given because there are 4 answers. So now choice is given. So this is your relationship between spot rate and forward rate. Now I'll come to a practical question. This can be a 1 mark question also. Okay, this can be a 1 mark question, and it is a 1 mark question happening. Very, very common in exam. See here, unlike previous question, spot is given, first year spot given, you have to find the 5 year spot. Now here, forward given. Okay. What is the value of a 3-year 4.25 annual coupon bond puttable? This is also 4.25. 4.25 is spot. Okay. Which will be annual coupon puttable at par 1 year from now if 1 year forward rates are given. Now, how do you actually do this particular question? Okay. So, what is 4.25? Is it 1 year spot or 3 year spot? It is 3 year spot. So, it is actually, it is here. 4.25 is given here. Now, 4.25 3 year spot is given. That is 1 plus S3 whole power. Okay, so what you will get here? 1 plus S3. 1 plus S3 you have got 4.25. F1, F2, F3 is also there. So now you have to find what is the value of, please look at this word, value. That means you have to find the present value. So, till the previous two problem, we were only relating the interest rates. So, we were not going to the present value. So, now it is a practical question. So, now we are connecting that interest rate to the value. So, present value. So, as per this formula, you have to put present value before this. Present value into 1 plus S5 whole power 5, which is equal to present value into 1 plus S1 into like this. So, the same model I am going to replicate here. Okay. So, the same. Now, here, instead of you have got how many years you have got? You have got actually 1, 2, 3 only. Okay. So, technically, it is 1, 2, 3. So, 1, 2, 3 means this one. So, this is the formula I will use. Okay. So, let me take you to the third question. So, what I will do here, 1, 2, 3. Okay. Your forward rates. So, what's your forward rate? 2.5, 3, and 4.5. 2.5, 3, and 4.5. Good. So, now what I will do, he says, what is the value of 3-year 4.25 annual coupon bond puttable at par 1 year from now? If 1 year forward rates at T0, T1 and T2 are 2.5, 3, and 4.5. So, value of a 3-year 4.25 annual coupon puttable bond 1 year from now. So, present value, take it as 100. So, what is your spot rate for 3 years? 3-year 4.25%. Yeah. So, I said you have to find the equilibrium value, equilibrium present value. Okay. So, find the future value. So, your present value into 1 plus.
इसका आपका
Lokesh Mittal by you have to.
इसकी फोटो कॉपी मेरे बैठ दो.
Mr. Lokesh Mittal, you have to meet. Mr. Lokesh Mittal. Yeah, thank you. Thank you. So, future value is present value into 1 plus r whole power n. N is 3. So, this is your sorry. So 113 points. So my present value is 100. My future value at 4.25% is 113. Now, 1 year forward is 2.5. 2 year forward is this. 3 year forward is this. So I'll come back. So what I will do now, so my future value 113.30. What I will do, 113.30, I will divide by 1 plus R. So I will get the present value at the end of second year. Now this I will divide by 1 plus R. I will get this at the end of first year. Now this I will divide by 1.25. So I'll go back to the beginning of 0. So 102.70. So this is the value of the value. Okay. So this is how we will actually equate it. So equilibrium. I told you the equilibrium. So a bond at 100 and 4.25% for 3 years will be equal to bond sold at 102.70, where you enter into a forward rates. First year forward rate 2.5, second year forward rate 3, third year forward rate 4. See, naturally, your first 2 year rates are very low because part rates 4.25 for 3 years you are getting. So naturally, it will be costly. Okay, it will be costly. So 102.70. So you have to be very careful in understanding the relationship between the spot and forward and how it is related, how it is connected. Okay, very interesting question. Please look at this forward rates and 4.25. So naturally 4.25 is you get more compared to this. Please see the average of this. Very simple. What is the average? Average is 3.33. But here you get 4.25 for 3 years. Every year you get 4.25. But here on an average you get only 3.33. So naturally you have to invest more to equate at this value 113.30. Similarly, if the average of these 3 is higher than 4.25, it will be lower to match this because every year compounding will be high. So it's a very simple arithmetic, but conceptually you have to understand what it is. So 1 mark here. Okay, good. So now we are moving for the next important case study. Okay, good. I'll try to do a Black-Scholes model also, maybe if you are comfortable, because I'll break into small pieces and then try to do one question also. And here I want to do one question on this is a very interesting question. I'll come to this a little later. Okay. So let me first complete this one. Then I'll take you to that one. So this is Black-Scholes model. So because since I have already done this for you, I'll do this in a different perspective. Okay. So first let me explain this. And I'll explain this formula also. And possibly, since it is there in your syllabus, you must ensure what it is and what is put call parity. You will get a question on put call parity also. It can be 1 mark question. Okay. Now, I'm going to explain this particular question. So please pay your complete attention. Okay. Please pay your complete attention. So, good. So guys, the following are the prices of an options traded on a company which pays no dividend. I want to make one point very clear here before I go into this question. This concept of dividend has been well researched by Merton. So the original formula for valuation of options was brought out by Black and Scholes. So that is why in your syllabus, if you look at the syllabus, you will have Black and Scholes model, Black and Scholes Merton option pricing. Both will be there. Okay, both will be there. This binomial tree I have already done in the previous thing itself. So I'll try to do this particular part because this is a very important concept to understand. So spot and forward is here, okay, in your syllabus, and by Black and Scholes is here in your syllabus. Good. Now, the only difference between Black-Scholes model and Black-Scholes Merton model is Merton did further work on Black-Scholes model, and he evolved an extension of Black-Scholes model by bringing one more factor in the valuation of Black-Scholes, and that factor is dividend. So between the contract date and the exercise date, if there is an income which accrues on the asset, underlying asset, will it impact the pricing of the option? This is the question. Definitely it will have an impact on pricing of the option. Now what will happen? For example, your option price is at spot rate, but your dividend is, for example, it is a 3-month option contract. At the end of 2nd month, you get a dividend. If at the end of 2nd month, you get a dividend, this will have an impact on your option price. And we already know this. For example, here, I showed you this. Please look at this dividend. Will decrease the call. Why decrease the call? Because it is an income for the writer. Because he is going to hold the asset. For example, call option means option holder, option writer. Option holder is going to buy. Option writer is going to sell. The option writer is going to sell. He will hold the asset. If he is holding the asset, then dividend who will receive? Writer only will receive. If writer receives, he is earning income. So therefore, because of this contract only, he is earning income. So on the option value, he is earning the call premium. He is earning. And 2 months later, he is also earning the dividend. So your call premium, if is for the what is called as call premium, it is an intrinsic value plus time value. Intrinsic value here plus time value. In the time value, you get a dividend. So that dividend, 2 months later, whatever dividend you get, you have to take the present value of the dividend and subtract that from your value of your call option. That is a subtract means reduce. So call option decreases when dividend is earned by the call writer. So this is the logic here. Now please be very clear with the logic. Arithmetic will be very simple. Okay. Now, so where am I? Here. Yeah. So Black and Scholes Merton model, Black and Scholes model, only difference is one more factor is considered. That's it. So I'll try to bring in that one more factor also slowly. So without any dividend, and if dividend is there, what will happen? So that also I'll try to do one more question. Okay. For example, annualized riskless interest rate expects to pay a quarterly dividend per share. Okay. So this is Merton model. This is Merton model. So I will do first a model without a Merton, and I will do another model with Merton. So two models. Okay, please be careful. So let's do this question. Now, the following are the prices of options traded on MS Corp, which pays no dividend. Okay. Now, this is the price of options, call option and put option, exercise price, 1 month value of the call option and put option. Now, very similar question is what we did in the option binomial tree question. That is also a very similar exam question. And after this, I'll again do that particular question. Okay. So binomial tree question. So please wait. I'll do that also. The following are the prices of option traded on MS Corp, which pays no dividend. So I'll first calculate the value of the option. Then I'll compare with this market price. This is called market price. So whether it is overvalued or undervalued, that is where you have to pay your complete attention. Okay, to pay your complete attention. The stock is trading at 83 rupees, and the annualized riskless rate is 3.8%. Standard deviation in stock prices based on historical data is 30%. Okay. Now, so what is your stock is trading at 83? Stock is trading at 83 means it is spot price. And where is your excise price? Excise price is 85. Okay. So estimate the value of the 3-month call option. You have 85, you have 90. So call option. 3-month call option. Here it is 3-month call option. 3-month call option, but you have 2 excise price. So with the strike price of 85. So stock is trading at 83. So spot price is 83. Strike price is 85. So excise price is 85. The period N is equal to 3 months. So 3-month call option. Riskless interest rate. So R. Okay. So your interest rate is 3.8%. And time is equal to, it is 3 months. And in terms of year, it is 3 divided by 12. So 3 divided by 12 means 0.25. Okay. Then you have the standard deviation. So sigma. So I'm introducing a new term. Okay. Now, please understand the fundamental difference between a Black-Scholes model question and your binomial question. This is a binomial question. There is a put option and this is a call option question. Okay. This is a binomial option question. So first I'm giving the comparison between these two, and then slowly I'll try to get into the answers part. Okay. Now here also you have the spot price, you have the excise price, you have the interest rate, you have the period. So this 4 is there in your binomial model as well as in your Black-Scholes model. Spot, excise, interest rate, and period. Okay. So here it is. Spot, excise price, interest, and period 3 months. Now, what is not there, it is here. What is here, which is not there. Okay. In your binomial model, okay, this one. Okay. So you have the 2x. Why it's called binomial? There are 2 extreme prices only you will consider. One is an upward price, another is a downward price. So the price can go from 100 spot price to upward 25%. That means it can go up to 125. If it is 125, will you exercise or not? Similarly, downward from 100, it can go up to 80. So it can go up to 80. So 80 it can go, 125 it can go. But in a Black-Scholes model, it is a continuous and random pricing. Continuous and random pricing. The moment it is continuous and random, you have to get the standard deviation in stock. So, hope I have explained to you about how you will calculate the standard deviation and variance. Hope I have explained to you about MS Dhoni and Virat Kohli playing 2 innings and calculating the standard deviation. If I have not done so, please tell me. I'll calculate the standard deviation for it. So now, this is the fundamental difference. So there, the extreme prices are known to you. In Black-Scholes model, you will not know the price, how the price will move. Price moves continuously, randomly, but it goes, the risk factor is, the standard deviation of the stock prices is 30%. Now, what do you mean by 30%? Standard deviation sigma means plus or minus 30%. So it can go plus 30, minus 30. So average, and this is average. So not necessary that it should be always 30. It can be even above 30, below 30, okay, plus 30, minus 30, plus 25, minus 20, but the average will be plus or minus 30. So that is what the meaning of this. So please be clear about these 2 types of data. So once these data are clear, solving is just like that, you can solve it. And please try to do the modeling in spreadsheets, modeling. Try to do the modeling, slow and steady, try to do the modeling. Okay, good. Now estimate the value of a 3-month call option. I'll do this. So first what I will do, I'll do the binomial model, make you how it is done. And then I'll come back to this model, how this particular formula has to be fed into the system. So I will do the entire calculation. D1, I will do it in 3 parts. D1, part 1, part 2, part 3, and part 4, I will do D1. So I will do it in 4 steps. D1 itself, I do in 4 steps. Actually, the entire step is 5 steps only. First, you have to calculate D1. Second, you have to calculate D2. Third, you have to calculate ND1. Fourth, you have to calculate ND2. Fifth, you have to calculate value of call option. That's all. Similarly, put option, you can do it very simple. You can use the put call parity and find it. Now, the first step itself, I will do it in 3 steps. The logarithm of spot by excise price plus R plus sigma square by 2 into T divided by sigma root T. And these 3 factors, I will assemble it and I will divide it. So one by one, I will do. Aramse I will do. So please wait for some time. So the next half an hour to 1 hour, we are only going to do this. Okay. So first I will do a question on call option in binomial model. And then I'll go for question there with respect to what you say, the Black-Scholes model, call option. And in binomial model, I'll do a put option. And in Black-Scholes model, I'll do a put option question. So that now complete channel is clear for you. Okay, good. So let me do the 4th question now. Okay. Good. So what is given to you in this question? S is given, spot price. So spot is given. Exercise price is given. So spot is actually, we'll call this as S, we'll call this as E. And S is 100, E is 108. Okay. Interest rate R is 8%. Period N is 1. This is span. Upward limit is 25%. Downward, D is 20%. Okay. Now I'll call this as U as 1.25, D as 0.8. So downward price. Now why I'm saying this is U into S will be 125. D into S will be 80. So what is the upward price? What is the downward price? So that is why you want to have this US and DS. So please be careful with this. So now let me take you to the steps here. Okay, step 1. Step 1, you have to calculate CU, which is maximum of US minus E comma 0. So I'll put that here. So maximum of US minus E. So what is US? 125. What is exercise price? 108. Now this is a call option. I repeat, guys. This is a call option question. Okay. Now in market price it is 125. But with the writer, you have already entered into a contract for 108. So will you go to the market and buy 125, or will you buy exercise at 108? You will actually exercise at 108. So therefore, US is 125 minus 108. So 125 minus 108 will be actually 17 rupees. So 17 comma 0. So maximum is 17. So you have a intrinsic value of 17 rupees. So that is this is actually intrinsic value. So what is that maximum of US minus excise price? 70. So we call this as CU. This is step 1. Now what is step 2? Step 2 is actually CD. CD. Now what is CD? It's here. It is DS minus E. But DS minus E, your intrinsic value is 0. Actually, this is in the money. This will be at the money or out of the money. So generally, it is at the money or out of the money means you will not exercise. So your intrinsic value will always be 0. So why? Because in market it is 80 rupees, but you have agreed to buy from the writer at 108 rupees. So will you exercise? No, I will not exercise. So how will you do this? So it is maximum of DS minus excise price comma 0. So naturally 0. So this is step 1, this is step 2. Now what is step 3? Delta. Very important point, guys, very important point. Your delta is actually CU minus CD divided by U minus D into S. Okay, so this you can call it as delta. You will call it as option delta. Otherwise called hedge ratio. So what is hedge ratio? Your hedge ratio is the difference between call option. Okay, this is the difference between the call option, upper price and lower price, divided by difference between the price of the asset. What is this? U minus D into S means US minus DS. So hedge ratio is numerator difference between the call option divided by difference between the asset price, difference between the price of the assets. Okay. So our asset price. So your option delta is CU minus CD divided by, it is US minus DS. Now you need to understand one thing very clear. Sometimes what will happen, your U is actually 25%, D is actually 25%. So don't think that it is 25 minus 25, it is 0. Because that is why I changed this and I showed you that it is not 25 and 25. So 25 means it will be 1.25. And here 25 means it is 75. So technically it is 1.25 minus 75. Okay. So that is the meaning of that. So it is actually 1.25 and 0.75. So please don't jump to that conclusion. Both are not same. So the percentage wise, both can be same. But that is only the limit. For example, both are 20%. Just because both are 20%, don't think that, oh my God, this is going to be 0. No, you are wrong. Because this is not U and D. What is U? U is actually 1.2. I'm sorry. U is actually 1.2 and D is actually 0.8. Okay, please be careful. Please be careful. This is something which you will actually miss. And this has happened in examination. This has happened in examination. Both have been given, and oh my God, in formula both are the same. How will it become 0? Denominator 0, then it becomes infinity. My God. So nothing like that. Okay. So now step 3. So what is your option delta? Or just we can call it as delta. Okay. So delta is actually CU minus CD. What is CU? 17 minus 0 divided by US minus DS. Okay. So what is your US? 125 minus 80, which is, the gap is 45. So in top 17 minus 0 is 17. Denominator 45. So the difference between the two extreme price, difference between two extreme intrinsic value. This is called delta, and this is a probability. This is a probability. Good. Now step 3. Step 4. Step 4 is the borrowing equivalent. This is called the equivalent portfolio model. I'll tell you that dabba. I'll put it to explain that. So this is the equivalent with respect to put option is lending actually. So here it is borrowing. So for put option it is lending. So I'll tell you why this is called as a borrowing. Because we call this as an equivalent portfolio model. Okay. It is called as equivalent portfolio model. Now, why it is equivalent portfolio model? Please wait, I'll explain. Now, borrowing. Now, what is borrowing? UCD minus DCU by U minus D into 1. So, borrowing is equal to UCD minus DCU divided by U minus D into capital R. Okay. Now here small r is this. So I want a capital R. So that is your cumulative, which is 1 plus interest rate. So 1.8. So this is interest. So what is your investment plus interest? So what we call it as your cumulative value. Cumulative value including interest. So that is what it is. So now what is your borrowing? UCD, U into CD, CD is 0, minus DCU, D is 0.8 into CU. That is why numerator will always be negative. Numerator will always be negative. That's why borrowing will be negative. Divided by U minus D. U minus D C90. U minus D into capital R. Capital R is 1.0. Close bracket. So it is 27.9. So now what is your step 5? So step 5 is actually your value of call option, which is CO. So value of call option is delta S plus bar. Okay. Yeah. Okay, so your delta into S plus borrow. Borrowing is already negative. So your delta is 0.3778 into 100 rupees plus borrow. Borrowing is 27. So 9.7. So this is your value of your call option. So just note down this. Now I'll do a binomial model. As I told you, binomial model has how many steps? Sorry, binomial is over. Now I'll do a Black-Scholes model. Black-Scholes model, step 1, D1, step 2, D2, step 3, ND1, step 4, ND2, step 5 is call option. Very similar to these 5 steps I will do. But step 1 alone, I will divide into 1A, 1B, and 1C. Then consolidate 1A, 1B, 1C, I'll find one. Very simple. Okay. Same 5 steps only, I'll do that also. Okay. So just be clear with this. I'll give you a few minutes break. Okay. So I'll give a 10 minutes break. So relax and refresh. I'll be back.
मीनू मामी कह रही है छुट्टू से बात करनी है वीडियो कॉल पे। आओ
अभी नहीं है बेटा, नहीं सुना नहीं।
कहाँ पर जाए तो बोले सर।
Yeah. So now, so this is the question 4 we did just now. What I will do for the same inputs, I'll do a put option. Okay, for the same inputs. So this is question number 5. So what I will do, maybe I'll copy this. I was supposed to explain to you the equivalent portfolio model for the call option. So I'll explain this, then I'll go for this put option. Because the questions are same. So only this formula alone will change. All this will change. Okay. So maybe I'll change the color. Yes. Now, what is this equivalent portfolio model? Step 1, step 2, step 3, step 4. This is from a writer perspective. Okay, writer perspective. These two I will actually merge it. These two also I'll merge it. This is spot and this is forward. So spot, what I will do, I will borrow money. This borrowed money I will invest in an asset which I am supposed to deliver to the call holder when he exercises the call on the exercise date. So I'll borrow money, for example, 100 shares of a particular company, 100 numbers of a particular company. So what I will do, I will borrow money and I will invest that in today's price itself, so that I am actually hedging my contract, my option contract. I'm hedging, so I'm covering my option contract. Step 3, he will exercise. When he exercises, I will sell this investment to whom? To whom I will sell this investment? I will sell the investment to the call holder. And whatever money I realize, I will use to pay the or settle the borrowing. So borrow and invest, sell and settle. So in spot, borrow and invest. In forward, sell and settle. The same model will be reversed, will be replicated. Okay. So this is called replicating portfolio model. Okay. You can either call this as an equivalent portfolio model or you can call it as a replicating portfolio model. It is replicating a portfolio model. Now the same steps, I will be doing it for put option. But here, I won't borrow and invest. Rather, I will lend. Okay. I will sell the stock and invest. Sell and invest. So, I will sell and lend the money. Okay, I will sell and lend the money. Now, as a put writer, you are supposed to not sell the asset. You are supposed to buy, because put holder will actually sell. So, put writer have to buy. So, step 3, he will buy. So, when he will buy, only when he realizes the lent amount. So, he will realize the lent amount. Okay, that means he will, whatever money he has lent, he will realize along with interest. And then he will buy. So he will buy from the put holder. So this is the equivalent portfolio model. So this will happen in forward. So this is spot, and this is what happens in forward. So similarly, what happens in spot? Okay, this is what happens in forward. Okay, so now let me try this same question for a put option. So spot price, exercise price, rate, R, capital R, cumulative 1.08, limit, upward limit, downward limit, small u, capital, small u, small d, and USDS, everything is same. Up to this is same. But step one, what is step one? Please look here. This is a binomial option put. So what I will do, I'll maximize E minus US. Yes. So this will be called as PU. So I'll maximize exercise price minus US, which is 125, comma 0, which will always be 0 only. Because what is put option? The upper price is 125, exercise price is 108. Now, in market, it is selling at 108. Should I have to sell at 108 to the option writer? Okay, so that he will buy at 108. No, I will sell it in the market at 120. So therefore, my PU will be 0. Now, what is PD? It is a maximum of E minus DS. Yes. So exercise price minus DS, comma 0. Naturally, market it is 80 rupees, but you have entered into the contract to sell at 108. So naturally, 28 rupees margin is there. So I will actually exercise to sell at put option means option to sell. So I'll exercise at 108 because market is low. So PD. So intrinsic value is 28. Now I'll go to the delta. Actually, it is not B, it is L again. It is not B. So here it is the delta. Okay. Option delta. So your option delta, other is called hedge ratio. So what is your option delta hedge? PD minus PU. So PD minus PU divided by U minus D into S. U minus D into S. So PD 28 minus PU 0 divided by U minus D. U is 1.25 minus 0.8 into S. S is 100. Or either you can say US minus DS. Both are same. So that means the spread is 125 minus 80. You can either do like that or like this. That's all. So 0.622. Now you need to understand one thing here, guys, that your delta of call option plus delta of put option, you both if you add, it will be 100% for the same set of data. Okay, so it's only the two sides of the coin. Okay, for your kind information, just to check. Okay, so this is your delta. So what's your step 4? You are lending. So how much you lend? Okay, how much you lend? You lend. Okay, this is lending. So you lend UPD minus DPU. So UPD minus DPU divided by U minus D into R. It's the same. U minus D into capital R. So U into PD. minus D into PU. Okay. Divided by U minus D into capital R. So this is your length term. So now what is your value of put option? So value. So value of put option is length amount minus deltas. So length amount minus delta into S. S is what? 100. So 9.79. So this is your value of put option. So here your value of call option is 9.79. Value of put option is also 9.79. So incidentally, both seems to be same here. Okay, good. Now I will take you to. I given another 2 more questions for you to practice. Value of call option using binomial model. I've just changed the numbers. Okay, you can try this. Now I'm taking you to the Black-Scholes model. So here I will take this. He says estimate the value of a 3-month call with a strike price of 85. Now here I will take this question number as 11 actually. So here the stock is trading at 83. So the spot. So S is actually 83. Then with a strike price of 85. So exercise price E is 85. Okay. Then 3-month call option. So time, I'll call it as T. It is 3 months. 3 months in terms of year would be 3 divided by 12. So 0.25 years. Okay. So I'll call this as 0.25 year. So spot price, exercise price, time. Then you have the annualized risk-free rate. Okay. So I'll call this as risk-free rate RF. So I'll call it as R, which is actually 3.8%. Okay. Annualized. So it is per annum. Now the standard deviation of the stock price. So it is called sigma. Okay. Check whether we have a single. Or maybe I'll take it from here. These things are actually, I think I'll take it. Yeah. So sigma. So sigma is what in this question. 30%. Okay. Now you can also calculate the variance if you want. So variance is actually a sigma square. So sigma square. So sigma square is actually 30% into 30%. So it is 9%. Okay. Good. So now how do we calculate the value of the call option? Okay. Now, like how we understood the replicating portfolio model, in understanding this, I will also explain this entire arithmetic practically also. Okay. First, we'll understand the calculation part. Okay, then we'll go for the practical part. So, using the inputs from the Black-Scholes model, specify how will you replicate this call. So, that is the practice part of it. What is the implied standard deviation of this call? Using put call parity, estimate the value of the 3-month put with a strike price of 85. Okay. So now we are going to find the value of the call option. Now, how do I going to do this? So, like your 5 steps here. Okay. I will do the same 5 steps here, but please look at this. So, this is the value of the call option and put option. This is the value of the call option. So, spot price into ND1 minus K is called the exercise price into the present value of the exercise price into ND2, where D1 is this and D2 is this, or D2 is D1 minus sigma root T. Please don't be bothered about these formulas. Very simple I will do. Okay. This is in simple I have done this. Okay. In simple terms. I'll explain this. So what I will do, step 1, I have to calculate D1. But D1, I'll do it in 3 steps. 1A, 1B, okay, and 1C. Based on that, I will do step 1. Okay. So I'll call this a small a, small b, small c. Good. So based on these 3 steps, or maybe I'll cut this and put it here. I'll do the step 1 here. Step 1 is based on step 1 ADC. So what is step 1? We have to calculate D1. So D1, what do you mean by D1? Okay. So what is D1, guys? So it is D1 is actually logarithm of spot price by exercise price. So logarithm of spot price by exercise price. Please look at the numerator. Logarithm of spot price by exercise price. This is 1A plus the R, that is interest rate plus sigma square by 2 divided by 3 divided by T. Okay. R plus, okay, that is R. R is your interest rate. Okay, 3.2. So R plus half of the variance. So sigma square by 2. So this is your sigma square. So R plus sigma square. So sorry. So R plus sigma square by 2 whole into T. Okay. So this is by 2. the whole into t. So t is your time. The time is how much? 0.25. So this is step 2. Now what is step 3? Denominator. Sigma into root t. Sigma into square root of t. So sigma into square root. Sigma into root t. So this is step A, 1A, 1B, 1C. And what is D1? Your logarithm of S by E plus R plus sigma square by 2 into T, whole divided by the sigma into root t. So meaning 1A plus 1B whole divided by 1C. This is what I'll do in T, D1. So now what is step 2, which is D2? Now what is D2? D2 is very simple. So D2 is actually D1 minus sigma root t. So D1 minus your sigma into root t. So sigma into root t is your step 1c. So 1c already is known to you. So sigma into square root of t, directly you have calculated, straight away you subtract. So D1 is 1a plus 1b by 1c. D2 is D1 minus 1c. Okay. So D1 minus step 1c. Very simple. Okay. So this is step 1a. This is step 1b. This is step 1c. Very simple. So now what is your next step? Your step 3. Your step 3 is actually you have to find ND1. N into D1. Oh. So what is your step 4? Step 4 is you have to find the normal value of ND2. Okay. So how do you find that? You have to find the normal. You have to go to the normal table, a normal distribution table, and find the normal value of the ND1. Okay. So that is what it is. So we'll do one by one. Now what is step 5? Your step 5 is your value of call option. And what is your value of call option? It is spot price into ND1. What is ND1? Step 3. Spot price into step 3 minus ND2. What is ND2? Step 4. Into excise price into E power minus RT. Actually, what is excise price into E power minus RT is otherwise called E divided by, that is excise price divided by E power RT, which is nothing but the present value of the excise price. Normally, your present value of excise price means you will have your future value divided by 1 plus R whole power n. Now, that 1 plus R whole power n is for a, what do you call it as the compounding for a fixed period, where the period is fixed. But this is a compounding for a continuous compounding. This is for continuous compounding. So I have to explain what is meant by continuous compounding, and then I will explain this particular part. Okay. So I have to take one question on continuous compounding. Okay. So please wait. This is what we need to understand about continuous compounding. So once you understand this, we'll be in a position to appreciate the present value of the exercise price. Okay. So please note down this question. I'll explain this. Now, I will explain this particular 37th question to you. Okay. Then I'll come to this, because once I explain you the compounding, continuous compounding, you'll be in a position to understand the present value of the exercise price. Please look here. We are going to find the effective annual interest rate at different frequency of compounding. Now, how are you going to find this? Okay. And this is a concept which is also explained to you in India is 109 financial instruments in para number B 5.4.1 and B 5.4.7 in appendix A of India is 109. Now, all of us, we know that future value is equal to present value into 1 plus R whole power n. We know this. This is the formula for compound. Okay, this is compound. And this compounding is annual compounding. Now, the same formula I'll do it for compounding, which will be intra-year compounding. So how will you do this intra-year compounding? So I will divide n divided by the number of times you are going to compound in a year. So I'll call this as t number of times. So I'll then multiply n into t. R divided by t whole power n into t. Now I'll explain this. Okay, I'll explain this. So please look at this question, all of you. So we have 1%, 5%, 10, 15, 20, 25, 30, 35. Okay. So I'll call this as nominal interest rate. This is your nominal interest rate. And it is 1, 5, 10, 15. 1, 5, 10, 15, 20, 25, 30, 35. Set. So this is your nominal interest rate. Now, what if the frequency of compounding is 1 year? So here how many? 1, 2, 3, 4, 5. I'll have 6 columns. So 1, 2, 3, 4, 5, 6 columns. Frequency of compound. Okay. If the frequency of compounding is annual, semi-annual, okay, quarterly, then monthly, you can even have weekly also, daily, and you can have continuous. Yes. So then how do you actually do this? Okay. Now, if it is what is where equated annual interest formula is 1 divided by n whole power n minus 1. Okay. So that means n means the number of times you are compounding in a year. If it is only annual is 1, then 1 plus r whole power 1 minus 1. That's all. So here it will be annual means 1 within year 1 times only, intra year means 1. Semi-annual means 2. Quarterly means 4. Monthly means 12. Weekly means 52. Daily means 365. You can even do hourly also. Okay. I will actually do even hourly. It is 8,760 hours in a year. Continuous. So that means every second. So how do you do it? Okay, there is a catch. So let's do this now. So here it is 1 plus r by n whole power n minus 1. Answer will be same. Answer will be same. Same 1%. But instead of this, okay, so what I will do, A6, I have to yes. Now B14. This will be the same. But here, now if I change this here, it will be divided by 2 whole power 2 minus 1. Let me try this for, this is what you are, actually this will be a little more. Look here. So 4 decimal points if you have to take. Yes. This is your effective annual interest. So now I'll try this for quarterly, try this for monthly, hourly. I'm sure you are able to appreciate what I'm doing. But continuous alone, it is not same. Please look here. For continuous, it will be e power r minus 1. That is exponential. Okay, e power r. Okay. So it will be equal to exponential power r. R is actually 1%. Minus 1. Yes. This is your continuous. So 4 decimal, you can have up to 4 decimal. This is your continuous component. So this part is continuous. Please look at this formula. Please look at this formula. Exponential e power 35 minus 1. That's it. Now let me explain this in terms of, now what is the meaning of all this? Let me explain this. Maybe I'll reduce it to 2 decimal points. The meaning here is, if you have a rate of interest of 35% compounded per annum, and if you compound it semi-annum, the effective rate of interest is 38.06 per annum. So per annum compounding 35%, so that means that 35 divided by 2, it will become 17.5. Okay. So 17.5 you have to compound it, add, and again you have to compound it for 17.5. So technically per annum interest, it will not be 35, it will be 38.06. So if you are doing it for quarterly, it is 39.87. Effective rate, per annum effective rate. That is the meaning of the word called effective rate. This is effective rate of interest is 41.2. Effective rate of interest is 41.91. So actually there is a, what do you say, hourly. So hourly and the continuous is almost, it is almost same, but in 2 decimal points you will not see the difference. You have to see the difference with respect to 4 decimal points. Okay, please look at this. There will be a difference. This one. So it is 34.985, it is 34.986. Okay, maybe I'll even increase it to 1 more decimal. Okay, so very, very close, very, very close. So as the number increases only, you are actually able to see the actual difference between hourly and continuously. Okay, so where is the question? The question is here, and I didn't do this. I have not given it for annual and hourly here. You can try it for hourly also. Okay, so that's the meaning of this effective annual interest rate. Now, how this will work with respect to this is compounding interest. Now the same formula, if it is future value for continuous compounding, so I'll say it is not compounding, it is compounding not interest, it is compounding continuous. If it is compounding is continuous, then it is present value into e power Rn minus 1. That is e power Rn. So e power Rn minus 1. So this Rn alone, it will be in the numerator. So this is e power R into 1. So I'll put a star here. Yes. So e power R into 1. So this is your future value. Now what is present value? The same formula. Present value is equal to future value divided by e power Rn. Okay. So this is not minus 1. So present value into e power Rn. That's all. So not minus 1. Minus 1 is only for the effective one. Now, with respect to future value, present value, it is future value divided by e power Rn. E power Rn. Now, if this e power Rn goes to the numerator, what will happen? Future value into e power minus R. So it is minus R. So I have to take this minus to the power, that's all. So you either the present value is future value divided by e power Rn or future value into e power minus R. So anyone you can do. Maybe I'll just bring it very close. Now, what is future value? Exercise price. Okay. So if you want the present value of, what is present value of exercise price? Which is exercise price into e power. So same. So instead of future value, I will take exercise price. Exercise price into e power minus R. And this is what is used. So this is R into N. So this is what is used here. E into, that is exercise price into e power minus R. Exercise price into exponential power e power minus R. N is t here. Okay. N is number of period or t is time. So the same. So your second part is actually the present value of your exercise price. So very simple. Spot is actually in present value only. This exercise price into e power minus RT is actually present value. So technically, in present terms, so intrinsic value I'm actually computing. So spot price into ND1, it is actually the probability, okay, and ND2 into into the present value of the exercise price. So it's very, very simple. So let me now take you here. So that is your value of combination. Okay. So guys, now hope you are ready for the step 1, 2, 3, 4, 5. Okay. So we are now at exactly 12 o'clock. I'll give you another 5 to 10 minutes break. So after this break, I'm going to do this entire question. Okay. So maybe I'll complete it in another half an hour or 45 minutes. And after that, we can have some question answers and then we can conclude. Okay. So I'm going to give a 10 minutes break. Welcome back, guys. So now we are going to start with step number 1 here. So which is logarithm of, so I'm using a log function. It is spot by excise price. So spot is 83 divided by excise price, 85. So this is your logarithm of S by E. Actually, S by E is 83 by 85. So logarithm of 0.9764706 is minus 0.01034. So this is step 1A. Now what is step 2, 1B? R. R is actually 3.8%. Okay, plus sigma square. So what is your sigma square, which is 9% by 2. So this alone I'll put it in one small bracket. Whole bracket into T. T is what? 0.2. So this is step 1B. Now what is 1C? Sigma into square root of T. Sigma is 30% into square root of T. T is what? 0.2. So this is step 1C. So now what is D1? Step 1A plus 1B by 1C. So what is 1A? This. What is 1B? 0.027. Divided by 1C. Fine. So this is your D1. Yeah. So this is your D1. So now what is your D2? D2 is D1 minus sigma root T. Sigma root T already we have computed in step 1. So 0.15. Now what is ND1? That is normal distribution. So equal to NO. You have the normal distribution function here. NO RMS DIST of Z value. So this is your Z value. So D1. So 0.527662. So what is ND2? It is the normal distribution. You have to be very careful. You have to choose the proper one. So NORMS DIST of Z value. So this is D2. So 0.4678. So this is ND1 and ND2. Okay. Now what is your value of call option? Your value of call option is here, which is S into ND1. So S into ND1 minus your present value of excise price.
Hello.
So E into E power minus R.
नमस्कार सर जी. हेलो. हेलो. हेलो.
Mr. Gaurav Kumar Maheshwari, kindly mute your audio.
ठीक है गौरव दे पैर कितने पीले पड़ रहे हैं.
कौन से पढ़ रहे हैं?
Mr. Gaurav,
पीछे देख चलो.
Mr. Gaurav, please mute your audio. Okay, good. So now, so what is your value of call option? S into ND1 minus your
हालचाल ठीक नहीं है.
So Mr.
अरे
Gaurav,
बंद है जी अभी तो.
Mr. Gaurav Kumar Maheshwari,
क्वारंटाइन है घर में. हैं? अरे पता ही नहीं सर कहाँ फंस गए. आजकल क्या चल रहा है. पहले टेस्ट बताया था नेगेटिव, फिर कह दिया पॉजिटिव. हाँ
अंदर
हाँ तो आना जाना कहीं कुछ नहीं। अब
अंदर
बीच में वायरल फीवर था इतना, वो ठीक हुआ। उसके बाद नेका ऑफिस जाना ही चालू किया था। एक ही दिन जा पाए थे, दूसरे दिन जा रहे थे, फोन आ गया कि आप ये हो गया।
I'm not the host here.
अब
विजय
क्या
कुमार
खा
गुप्ता,
रही
अरे
है?
अब आ कहाँ से जाता सर, घर पे ही क्वारंटाइन कर रहे हैं। अब ये निकले तब आऊंगा मैं। कहाँ चलाया?
तो
अरे चल यार, तेरी माँ बात कर रही है फोन पे।
चले जाओ, तुम चले जाओ ना, बुला रहा है।
okay. So e power e into, that is excise price into e power minus RT. So into e power minus RT. Okay. Into ND2. So this e power minus RT, this is what I just now explained to you in the continuous component. So I was referring to this particular point, e into e power minus Rn. So that is excise price into exponential power minus R. So that is what it is. This is a present value into ND2. So spot itself is present value only into ND1. ND1 is already, we got it here. So these are the four answers, guys. So these are the four answers we already got. Fifth answer I'm going to find out. So equal to S into ND1. So what is S? 83 into ND1. Already I got it ND1. So 0.5277. Minus excise price 85. Okay. Into, or I'll find the excise price separately. Okay. For example, I'll copy this again. So what I will do, I'll only find what is the present value of the excise price. This is present value of excise price. E power minus RT. Excise price into e power minus RT. S is actually your spot price. That is your present value. So directly 83. So this is 85. So what I will do, I'll find the excise price is what? 85. So 85 into e power minus RT. So exponential of minus RT. So what is your R? R is 3.8 into T. T is 0.25. It should be negative. So close it. Okay. So e power minus RT. Actually, to the power you need not put. Exponential function itself means anything you put within bracket, it means it is to the power 1. So this is your present value. So 85 is your future value. 84.1963424 is your present value. Okay. So that's your present value. So now you have got the value of call option. So S into ND1 minus present value of excise price is 84.1963 into ND2. ND2 is 0.4969. That's a okay. 4.40 is your value of call option. Simple. So very simple, guys. Okay, 4.40. If you want in 4 decimal points, 4.40. This is 4 decimal points. Okay, I can keep it in 2 decimal. Because all these are D1, D2 and all, you can keep it in 4 decimal. Being this in rupee, you can keep it in 2 decimal. So that's in simple terms. How do you value your value of call option using binomial model? So this is your question on binomial. So estimate the value of your 3-month call with a strike price of 80. Okay. So this is your answer. Answer of 11A. Okay. So this is answer 11A. Good. Now let me take you to the 11B. Using the inputs from the Black-Scholes model, specify how would you replicate this call. Now, this is what I want to compare this model with your equivalent portfolio model, replicating portfolio model. Okay, so I'll explain this. So, how do you replicate this? Replicating portfolio model. So, how do you interpret this? That's the point here. Okay. So, what is ND1? Okay. What is the meaning of ND1? So, I will say like this. Now, you will actually borrow what money? Because very similar to this. You will borrow and then you will invest. Invest means you have to buy. Okay. So, what you will actually borrow? Okay. So, you will actually borrow this part. This is the part you will borrow. Yes. So how much you will borrow now? E power minus RT is 84.1963 into ND2. ND2 is 0.494679. So that is where, so it is 39.39. So ND2 into E into, that is excise price into exponential power minus RT. So this is the amount you will borrow. Okay, in short. And what is the what you will buy? Okay, so as per this model, you have to borrow and invest. Okay, buy, otherwise called invest. The step of step 1 and 2. Okay, spot. So what you will do? So you will actually buy the ND1. So what is ND1? 0.5277. So how much you will buy? ND1. Okay. ND1 shares of stock. So how much? Which is 0.5277. So this is the, so 0.5277 shares of stock you will buy using the amount that is borrowed, which is rupees 39.3. So that is the meaning of this, using the input of Black-Scholes model, specify how will you replicate this call. Okay, good. So that is your replicating portfolio model. Now, this is actually Black-Scholes model. Yeah. So now what is your third question? What is the implied standard deviation in this form? Now, what is the estimate the value of 3-month call option? We have estimated it as 4.40. 3-month call option 4.40. Now look at the question. 3-month call option at the excise price of 85. It is 4 rupees. So If it is 4 rupees, what is your standard deviation? So this is quite a different one. So what I will do, I'll just copy this question and paste it here. Now I think this will be visible to all of you. So is it visible to all of you? Yes. I'll delete this. So now what I will do, I have all these formulas are already there here. Already all these formulas are. Now the question is, what is the implied standard deviation? Now what is the standard deviation now? It is 30%. Okay. If the value of the call option is 4%, the value of the call option is what? What is the implied standard deviation if the value of the call option is 4 rupees? Because in market it is 4. The market is 4. If it is 83, 85.25, risk-free rate is 3.8, and your standard deviation is 30, variance is 9, you have the value of call option as 4. So now what I will do, I will actually find standard deviation. So this part I have to find. Revise the standard deviation. So what I will do, I will use a goal seek. Please go to goal seek and change this value to 4. By changing the standard deviation to a different value. So what is that? So from 30% it has now become 27 point some and odd. Okay. 27.5. So that means your variance is 7.6. So what is your question? Your question is, what is the implied standard deviation? So your implied standard deviation is 27.58. Otherwise you can say even 28. Okay. 27.58 or 28, whatever it is. So that is with respect to implied standard deviation. Okay. Now using the put call parity, I repeat, using the put call parity, estimate the value of a 3-month put option. So with a strike price of 85. So same question is same, but you have actually calculated in question number 11 the value of call option. Now I will go to step number 6. Step number 6 is value of put option. So how will you find value of put option? Using the put call parity. So what is your put call parity? It's here. That is your put call parity. Call option plus present value of the exercise price. Okay. So what is put call parity? Okay. So call option plus present value of your put call parity. I mean present value of an exercise price. So we already have the present value of exercise price. E into, that is exercise price into E power minus RT. Okay. So I will actually copy this. So this minus power RT should go up. So call option plus present value of exercise price equal to put option plus spot price. Okay. Equals put option plus spot price. So what is your call option? 4.40. So I'll give a different color now. This is 4.40. Present value of excise price is 84.1964. What is part price? Part price is 83. So now what is put option? Your put option is equal to call option plus excise price into e power minus RT minus spot price. So our e power minus RT, this alone I'll put it in the to the power. Yes. So now what is your call option? 4.40 plus present value of excise price is 84 minus spot price is 82. So this is your put option. Sorry. So this is your value of your put option. So value of your put option is 5.60. So what's your answer? It is 11D. Answer is that. Okay. So guys, I must thank you very much for the patience what you have shown. And many things we have already covered in our session itself, where most important is the duration, modified duration, sensitivity analysis of bond, and with respect to the call option and put option and binomial tree, which I have done for the 5,000 or 50,000 stuff. All these are very, very important questions for examination. And apart from this, whatever I did today, that is also very equally important, especially the spot rate, forward rate, and all this stuff. So thank you very much. So have a great career. My best wishes to each and every one of you.
Sir,
If
a query.
you wish to share something, you are welcome.
Query, sir.
Yeah, please.
May I ask something?
Yeah, please. Yeah, please.
Sir, just guide us. What are the tips to actually practice the things, because this is something which is very out of dated from all of us, and we know it is very important. Just give us some tips that we can have practices for the paper exam.
Number one. Okay, first point. Maybe I'll share the screen itself. Number one, I'll just share with you only 5 tips. Okay. Once this session is over, you've got the certificate, immediately go for exam. Don't wait for, no, I have to prepare myself, whether I will do it or not. I will give you one very simple point. Nobody has ever appeared in valuation examination with 100% preparation. Show me one guy who has got 100 marks. No. Everybody were trying to actually, until you click that, okay, yes, get the marks, let the mark sheet come. Until such time also people will not be knowing, okay, I will pass. That is the kind of examination is this, because the subject is so vast. So tip number one, immediately go for examination. So don't worry about it. So tip number two, very important. Have confidence. Can I make it? Is it possible? No, I want to pass. I have to cross 60. Don't have all this stuff. Go with confidence. Yes, whatever question is there, in first shot, whatever answer you are getting in your mind, try to click it. Don't maybe if you don't know the answer, put it in review. If you are knowing the answer in the first go itself, click it. Either it is second or third and first thought which is coming, pick it and go. That's all. If all the 4 options you are not able to understand, keep it for review or you can do it later. Okay, so have confidence. 3. Practice makes you perfect. Don't read the answers. Now, not only it is applicable for arithmetic 25 marks, it is also applicable for all concepts. Take your own notes. Your own notes, whether it is accounting standard, whether it is bond valuation, intangible asset related concepts. Take your own notes. How many types of intangible assets are there? Market related. Number 2, so customer related. Number 3, contract related. Number 4, technical. So like that, you list, you write. Once you write, only it will. For example, the 30 code of conduct. You have to write down. One of the code of conduct which was asked in examination. I'll just share with you an interesting code. Okay. Where is it? I'll just share with you one interesting question. Okay, how important it is. Please look at this. This is a question number 21. This is an exam question that was asked recently. A valuer shall ensure that he or it maintains written contemporaneous. This word records. This is given in underline. And what is the word they are good? Contemporaneous dash for any decision taken. It maintains what? Records, documents, books, and reports. Like that, 4 options are given. Records, documents are very close answers for your kind information. It's an exam question. Recently asked. Okay, so the moment that is why you have to read. You have to write. Not only reading, you have to write this. Point number 21. A valuer shall ensure he or it maintains written contemporaneous records for any decision taken. The reasons for taking the decision and the information and the evidence in support of such a decision. This shall be maintained so as to sufficiently enable a reasonable person to take a view on the appropriateness of his or its decisions and actions. This is asked. So all 30 are important. So take your own notes. Practice makes you perfect. So whatever questions I have done, see, just now I did this 11th question. What is this? Black Scholes. Black Scholes, you have to divide into small pieces. Don't expect the entire question should come in exam. For example, I did this big question. What is this big question? Yeah. Not necessarily that the entire big question has to come. One part can come. Put call parity alone can come. They may even ask ND1 and ND2. For example, there is another question which I want to do. Please look here. Now, this is a question where they are given S, E, T, R, ND1, ND2 directly they are given. So even step 1, step 2, step 3, step 4 is also given. Out of 5 steps, D1, D2, step 1, step 2. What is ND1, ND2? Step 3 and step 4. That is also given. So now what is left out? Step 5. See, you are given all these 3. If you want to replicate buying this car, how much money would you borrow? How much money would you borrow? Just now we did this. Just now we did this. How much money would you borrow? Where is it? Sorry. I'm sorry. Replicate. How much money would you borrow? E into exponential. This is the answer. So your ND2 already you have. So you have to only find E into exponential by minus RT and then multiply it. So you will directly get the amount to buy. If you want to replicate buying this call, how many shares would you need to buy? Just now I did it. How many shares invest? ND1 is the number of shares. ND1 already given in the question. So 5.5750 is the number of shares we need to buy. Very simple. Question looks, once you understand, answer is very simple. So how is it possible? Only by practice, practice, practice. So take your own notes. Don't take all this printout stuff and all. Take printout and have your own pad, pencil, pen, and write note 1, 2, 3, 4, 5. Your own notes. Your own notes. It is what can help you. Okay. Point number 4. Okay. Entire syllabus. Syllabus is just 10. Only 10. Serial number 1, 2, 3, 4, 5. The syllabus is vast. I agree. It is difficult to cover. But don't leave even a single area. Try to actually, and when I say cover the entire syllabus, people think that I will do multiple choice questions. MCQ is the last step. Don't start your preparation with MCQ. Absolute absurd way of preparing. You have to be strong. For example, case studies. Just now we have been discussing many case studies. Do you think that same will come? There are actually maximum 15 to 20 case studies only asked in exam. But this 15 to 20 case studies, they change the numbers. So if you try to actually remember the case or the answers, nothing can happen there. You need to actually work out and then arrive at the answers. And you need to know the process flow. You need to know the steps. You need to know the arithmetic methods. So therefore, unless and otherwise you have a grip on the subject, you appreciate what it is, you are gone for a toss. You're gone for. And no, this book has 3,000 MCQs, that book has 1,500 MCQs. So 3,000 MCQs is better than 1,500 MCQs. Today, I'm telling you guys, especially past 15 days, 1 month, those who are going for examination, everybody who was cleared the examination, I'm in touch with them. So almost 62 have cleared from our group. Okay, the entire the fast track group, 62 people have cleared, and I want all of you also to clear this examination. I'm in touch with every one of them, and especially recent pass out. The question banks are not from the past. New questions are there. New questions. So what can actually help you? Clarity in concepts. Okay, clarity in making your own notes only can help you, can get you the confidence. So entire syllabus coverage. Don't and syllabus, take a printout, take a yellow color the painter and then paint it, cover one by one. What has been, sometimes 50 hours is what we are doing in 50 hours is only to give you an idea that yes, syllabus is so much, please, and this is a lateral entry system. All of you are knowledgeable, all of you are educated. So it is presumed that you can actually prepare on your own and you can pass this course on your own. 50-hour training program has been put mandatory only to give you an exposure that what is the subject is all about. Okay. Very, very important point, guys. 5th point. I want to make one observation here that in examination, you have those 81 mark questions. Okay. And the, what do you call it, is 3 plus 3 plus 4. So 10. So that means it is actually 83 questions. So 81 mark, 81, 82, 83. And you don't think that 81, 82, 83 will be at the end. Sometimes the 81 will be in the middle. 82 will be in the middle. 83 will be in the middle with the 3 sub questions. So case studies will be in the middle. It is not at the end. And don't try to answer all the questions unless otherwise you are confident. There are, I will say, both the extremes are there. Okay, what is that extreme? There is a guy, there is a girl, her name is Sonia Ahuja. she cleared with the 64.5 marks by attempting only 63 questions. 63 only she attempted. She got 64.5. There was another guy who attempted 82 or 83 or some number of questions. Okay. He got 59.75. Now, what is the moral of the story? Moral of the story may be 59.75. If one wrong answer has been eliminated, I mean, not answered at all, he is cleared actually. So, can I conclude that no, you should only write up to, only you have to write 63 or 65. No, you can go up to 75. No, don't go to 85. Can I conclude like that? No. Don't conclude. You have to write above 60. Please be very clear. You have to cross 60 questions you have to cross. But whether you will stop at 65, 75 or 80 or 85, it all depends upon your calculated risk. So you have to take a calculated risk. What do you mean by calculated risk? When you are answering your questions, paper, they will give additional paper. Okay, make that as 3 separate one. Question number, whatever you are confident of answering, put that here and have a tally count of it. Okay, 48 questions, I am confident. So then you are attempting 12 questions where you are not confident. So 48 plus 12. 48 plus 12 is 60. But 60, you are not confident. 48 only you are confident. 12, you have a risk. Out of 12, this side, that side can happen. So you have to balance. Now, case study. Case study is a place where you can actually pull the mark outside. You can actually drag it beyond 60. But at the same time, case study also can pull you down if you are attempting it wrong. So even in case study, out of 3 plus 3 plus 4, 10 questions, those questions you are strong. That alone you take it. Maybe if there are 3 sub-questions in bond, you know YTM, take it. And there is a question on this free cash flow and there's a weighted average cost of capital, all this stuff and all. Out of this 3 or 4, 1 or 2 you know, 3rd or 4th you are not sure about. Don't attempt. Leave it. Leave it. So that is what is called calculated risk. You take a risk to the extent you can actually cover up through your answered questions. So you need to balance. It is not that with the case study I will try to sail. No. With the case study also you can't. I'm strong in case studies. 1 mark I'll manage. No, I'm strong in 1 mark. I'm not good in case studies. That also not possible. You need to balance both. You need to balance. Now here also 1 or 2 I'll miss. Here also 1 or 2 I'll miss. So you have to balance very, very carefully and you have to come up. That is where the challenge lies. And don't hesitate. Don't hesitate and don't have a reservation to attempt exams. Oh my God, what will happen to my result? What my son will say, what my daughter will say. You know how many attempts I have taken, I don't want to tell. Every time when after writing my examination, my son will ask, oh, next time, when you will book for the next exam? This is the question you'll ask. So I took it as a challenge. One day, every time I will tell him, see, one day I will come with a pass mark. At that time, you only have to give me treat. So it happened. So by experience, because when my batch, I belong to the first set. There was no predecessors for me. I cannot even ask my previous set. So I have to write examination and get myself experienced. And today it is what is happening. Of course, we have the groups and all this stuff is there. Only what is the purpose? You share questions, you share. You share questions, you will get, others also will share. So try to get that info and try to manage your risk in your examination. That's very, very crucial. So calculated risk you have to do in examination. So don't say that, no, with 1 mark, I'll try to sail out. With case study, I'll sail out. Both are required because 25 marks arithmetic. And 75, out of 75, another 4 or 5 marks they will ask only formula. So 25 plus 5, 30 marks, arithmetic plus formulas. You have to be strong in formulas. Almost some 60, 70 formulas are there, which from that 4 or 5 formulas will be asked as 1 mark question. Anything is possible. Or sometimes formula will be given, you have to interpret it. Or they will give the concept, you have to select the right formula. All stuff they will do. So it is, and I am actually doing 2 model exams. Okay, 2 model papers, which will be 83 questions I will be solving in 2 hours, 2 hours, 4 hours I am doing. So that model paper I will be solving. That means it will be like a real life, real exam scenario where the next 5 or 10 days, whoever are attempting the exams, I am picking up the questions from them, and that I am actually making as part of that. What is that model exam? So I am doing one session on IndAS, 2 days, 2 days on model exams, 2 days on case studies on DCF, another 2 days case studies on the bonds and options. So 4 hours, 4 hours, 4 hours, 4 hours. So 4 hours, I'm doing 2 model exams. So that actually will give you a real life experience. So real exam experience. So how your exam questions will be. And especially in this 2 hours, you have to go to FEMA, SEBI, RBI, income tax, okay, economics, okay, valuation, formulas, case studies, case laws, all the stuff you need to do it. So my best wishes, guys. So thank you very much for the opportunity given to me to be part of this team. Any other questions are welcome. So good. Then have a sumptuous meals and take rest, and then come for the model exam. Thank you very much.